So Mike Moore is a co-portfolio manager and research analyst at Veritas Asset Management. They co-manage the Net Group Investments Global Equity Fund for us and have done so for just over a decade now. They've done a fantastic job for investors. The fund focuses strictly on quality companies. They strictly valuation disciplined and make sure to protect capital on the downside as well. As you know, markets can be very choppy, and downside protection is something that's very valued by investors. Mike, good morning, and over to you.
Hi, good morning. Just checking you can see my slides, hopefully.
Perfect.
Thank you for the time. In terms of the what I'd like to run through today, it's just the implications of sort of the potential tapering and rate rising for equity investors. If we just start on the sort of the performance of the portfolio, over the last 3 months, the portfolio has returned minus 0.23% versus the MSCI World Index of basically flat. And over 12 months, the MSCI World has delivered 28.8% and the portfolio 22.5%. We would say in terms of the returns profile of the fund, the key point to note is actually we look for sort of defensive and durable growth characteristics. And also we do focus on that kind of downside protection, and with that as well, we are sort of valuation disciplined. So when we have fast rising markets, we typically tend to sort of lag those. And then in lower return environments over our history, we've done relatively better. So in terms of the return profile that we've seen over the last 12 months, that's not unexpected from the types of company that we invest in and the style and the style of the fund overall. In terms of the positive sort of contributors to start with, just sort of taking the top 3. So in terms of Catalent, which is a sort of a drug outsourcing company for pharmaceuticals, so has around sort of nearly 50% of its business is in biologics production. They actually announced stronger than expected growth, sort of forward growth in terms of their medium targets. So they've risen those from 6 to 8% to 8 to 10%. That was taken well by the markets. Alphabet, which has seen a strong recovery in advertising markets, and pre-pandemic had about 15% of its sales into travel verticals. So that's seen a recovery, but at the same time, the core structural business, if you take out the COVID impact, has been growing at around 22% per annum over the last 2-year period. And so that again has been a positive. And then finally, Thermo Fisher, which is a medical devices and diagnostics company, again has seen some beneficial trends from sort of the healthcare arena, and it is an area where it is taking share. And that again was a company that has increased its long-term growth guidance from sort of 5 to 7% to 7 to 9%. So that was taken well. In terms of the negative contributors, the biggest was Alibaba. Obviously, it is in the midst of a sort of regulatory tightening in China that's affected the internet sector. But in the last quarter, that obviously was compounded with some of the issues going on with the wider China economy. So a slowdown in terms of the growth rate, and also in terms of the Evergrande issues, concerns about contagion sort of filtering across the wider economy. In terms of going forward, Alibaba, we still believe, has a very strong set of assets. It's the leading e-commerce player in China with 60% market share, has a leading logistics network, Alipay, which is leading payments solution, and also Ali Cloud, which is the analogy in the Western in the US market would be sort of AWS. And so we still think that is a very strong set of assets globally when you compare it to the technology companies. And also we think they are most likely to be able to negate some of these stricter regulatory issues better than peers, and that's something that we're already sort of seeing in the past sort of 3 to 6 months. The other contributor that was negative was Canadian Pacific Railway. Part of that has actually been driven by the supply chain issues. So if you've seen any of the sort of photos of container ships being sat out at sea, not getting into port, Canadian Pacific Railway is obviously railroad across North America, and so that has had an impact, a near-term impact, just in terms of getting stuff onto the rails and shipped across the country. The final one that I'd pick out there is just Safran, which is a airline engine manufacturer, and really that has actually had a couple of sort of stronger quarters where actually the recovery in air travel has kind of filtered into its business, because they actually the cash flow generative part of the business is in terms of the aftermarket and maintenance, and some of the COVID sort of Delta variant issues have concerned investors that maybe the recovery might not be so strong. Our view is that it's just going to be quite bumpy, but in terms of the long-term sort of airline and air passenger dynamics, we think those are still structurally sound over the longer term. So moving on to sort of new purchases and complete sales. So in terms of the new purchase, we bought Amazon. That hasn't actually done as well as you think it might have, given the kind of structural tailwinds that it's had over the last couple of years. And part of that is worrying about the pull forward in demand that COVID has provided, as well as some of the supply chain issues that we're seeing and increased costs. We use that opportunity to actually to initiate a position, and the reason for that is actually the two parts of the business that we think are extremely valuable that are underappreciated is AWS, which is a 30% operating margin business and is the leading global sort of public cloud player. It's growing 37% a year, and also its advertising business, which is a $30 billion run rate business now, but it actually generates operating margins, we think, in excess of 50%. If you look at Amazon Group, that's only 6% at the moment, and so all of that extra investment is going into what you consider to be sort of more classically what Amazon does. And so when we look at it on a 5-year view, we think that these two businesses, although they'll only generate 25% of the revenues of the company, we think actually they are going to make up the significant majority of the value of the business, so upwards of 70%. And that's even putting a reasonably conservative valuation on the rest of Amazon and what typically you would think Amazon is. And so we think that's actually an interesting opportunity. In terms of the complete sales, we sold Abbott Laboratories, which is a diversified healthcare company, so has products such as Libra in diabetes care. But one of the things it has benefited from is COVID testing. We have always viewed that as kind of a bit of a sort of a 1P type business, or maybe a couple of years sustaining. And what has happened is the market has factored in these COVID revenues, but then kind of extrapolated that to a degree. And from our point of view, when we looked at the IRR, that was getting compressed into sort of the lowest mid-single digits, and given that, we took the opportunity to actually sell the position. It's still based on our universe list, but we thought the risk reward had been fully reflected. Nestle likewise was actually the compression in IRR, to sort of 4%. Again, it's performing very well. It's just achieved sort of 8% organic growth in sort of the last quarter. But again, it trades at sort of 25 times a PE, and that is relatively full in terms of the context of the peer group. And from our point of view, that the risk reward was less favourable, and so we sold the position. In terms of the overall fund, the two largest positions are still Alphabet and Charter, which are 13.5% of the fund. That's slightly down from 15% previously, and the fund is more exposed to the North American markets with 68%. I think the sector weightings are actually more interesting. So in terms of the healthcare exposure, that's 27.6%, but that has come down a couple of points with that Abbott sale. And then if you look at communication services, information technology, and consumer discretionary, those were actually all quite sort of TMT exposed. So communication services holds Alphabet and Facebook. IT is obviously sort of technology, and then consumer discretionary is actually Alibaba and Amazon. So that all of those together make up around 34.5% of the portfolio. In terms of cash, we're running with about 7% cash at present, and that's actually sort of trickled up over the kind of last 3 to 6 months, as we've seen some of the valuations sort of get more towards fair value from our perspective, and so we'll look to redeploy that if and when we get a chance on a sort of an absolute basis. In terms of the sort of thematics on the fund as well, this is unchanged. So the one thing I'd say here, the two big themes are probably big data mobility, which it really is kind of digitization, which is factored into the technology positions, and then also with value-based healthcare, Baxter, CVS, Cooper companies, which plays into the trends of sort of longer-term demographics of aging populations, and also improving efficiencies within the healthcare space as well. So those would be the two sort of main sort of significant themes, I'd say, although there are 6 there. Having spoken about the fund, in terms of the second part of the presentation, I just wanted to just touch on sort of the implications of sort of potential tapering and rate rises for equity investors. I think the first point to note is, what is tapering? Obviously, tapering is the kind of the opposite of QE, and it's interesting just to look at the ways that the Fed looks to manage expansion and stimulus in the economy. So the one way that it does that is it affects the interest rate, which is effectively the price of money. It does that through the Fed's fund rate at the short end of the spectrum. So that's near zero now today. But also that is sort of lower bounded, and if that's not enough, then QE can step in, and QE is when the Fed will actually purchase longer dated securities, government bonds and mortgage-backed securities, and actually put money into the system that way, as well as and what that does is actually increases the prices of those bonds, which actually suppresses the yields. And so what you've had is, more broadly, is that the kind of the reference yield, Fed's fund rate, is actually is being held low by the Fed, and that's actually having an impact on asset prices, because that is the reference yield. If we look on the next slide, yields have been repressed. If you look at the 10-year monthly government bond yields, those are somewhere south of 2% for all kind of the major economic regions, and that is at multi-decade lows. When you've got that compressing, obviously the earnings yields and riskier assets are actually pulled in as well, and the reciprocal of those is the PE ratio. So what you end up having is actually extended valuation ranges potentially in sort of areas such as the equity markets. And if you look at the right-hand slide here, you can see that the Shiller cyclically adjusted PE is just under 40 times, when in the last 60 years it's only gone above 40 times at one other point, and that was the dot-com boom and bust. If we look at what is driving a potential increase in or normalization in interest rates, well, inflation is the key, a key factor, and I think the thing that most people are, focused on at present for understandable reasons. And if you look at the PPI and the CPI measures in the US, you can see that actually those are sort of in the 6 to 7% range, which is significantly higher than anything we've seen really in the last decade. That is coming from both inflationary sort of angles. So cost push is really a factor in that job openings are rising, but actually the return to work, there's still hesitancy there. Secondly, you've had some of the supply chain issues that have been discussed pretty widely, and also raw material price increases, and so that is obviously pushing up inflation. But then on the demand pull side as well, what you've seen is the fiscal stimulus that the government and the US government has enacted. The personal income in totality has risen by 25%, and actually a lot of consumers have repaired their personal sort of balance sheets. So you've got a situation whereby that's actually sort of influencing the cost push side as well, but you're having a demand pull and a cost push sort of factors impacting inflation. The bigger question is, to what extent is this transitory? And I think that's still very much an uncertain outcome. And you can see that in the FOMC comments, in their expectations, that there is no clear view on this. And you know, there are clearly elements that look like they could sustain more for a longer period of time. It's very difficult to actually call that you know, significantly one way or the other in our opinion. What we do think, though, is obviously with these inflationary aspects, you know, that the reduction in sort of the tapering and also sort of rate rises, that does have impacts in terms of the stimulus. It also has impacts in terms of sort of the discount rate you're using. And so what you've seen is longer duration assets have done very well as those interest rates have fallen and those yields have fallen. And what you're seeing now is potentially a reversion in that. And the issue here is that you know, a dollar of cash flow very far into the future is worth relatively less on a net present value basis when discount rates are higher, and nearer term cash flows are actually you know, are potentially more valuable on a relative basis. And if you look at the right hand chart, which is the MSCI World Software and Services sort of value sort of index, from a index perspective, that has tripled effectively over the last sort of 3 or 4 years. And if you look at the PE of that sector, it's now near 40 times, which again is a level that we haven't really seen, since the dot-com crash. And one of the things there is there are a lot of companies even within that aren't actually generating profits, and so that payback that you're having to wait for becomes relatively sort of less attractive and potentially exposed. So with that in mind, it's very important to keep an absolute valuation mindset. That, you know, that is imperative. And so when we actually forecast and we actually put into our sort of modelling, we do actually take a conservative view of kind of normalisation of interest rates that we think you have to consider. We also, given that the kind of inflation's the other side of this, because that's one of the reasons why interest rates will you know, likely have to normalise to some degree. You know, the pricing power is a key differentiator, and with technology and with the software space here, one of the issues is actually many of these companies do have pricing power, but then the valuations are extended, and so we do think that kind of valuation reset could well dominate for some of these companies that have got much more speculative valuations that are very long dated in terms of their return. So altogether, you know, how should we invest given the context? Well, you made a couple of points in the previous slide, but the key ones we think are pricing power. We think given the uncertain nature of the environment and the inflationary factors we're seeing, we think having pricing power is really important. So for example, Microsoft recently increased its prices for Office by 10 to 15%. This is actually the only price rise they've done in 10 years, and they're still charging only $20 to $30 a month for Office. And so we think there's considerable pricing power there for companies like Microsoft. The competitive advantage is also extremely key, because in these, you know, in sort of tougher more competitive markets or tougher markets, it's actually usually the ones that are the kind of the leaders that actually extend their relative position. You want structurally growing markets, because that also gives you more latitude and flexibility, and also can protect against some of these inflationary factors depending on how persistent they are. And then the fourth one is not, you know, to be overly indebted, because, you know, if your interest rates are rising, that has a disproportionate impact on free cash flow as well. So taking those together, what we really want to have is companies with that high degree of self-determination, and that's paramount. But then you have to marry that with the valuation discipline, because that's one of the things that we're seeing is the valuations do look extended on a historical basis. So staying disciplined about the opportunities of when they arise. And we think if you put those together in what is an uncertain environment from an inflation perspective and a growth perspective, then actually we think you will have a you know, durable performance over the medium to long term, and that's something that we look to achieve. With that, I'm happy to take any questions.
Okay, brilliant. Thanks very much, Mike. That was very insightful. Just a reminder to everyone on the call today that we are taking live questions for this segment. So just please feel free to click on the button in the top left-hand corner of your screen, and those questions will come through to us. So Mike, just one very quick question. We just have about a minute left. So on Canadian Pacific, I mean, they won a bidding war by actually not putting in the highest bid. How did that happen? How did they pull that off?
Well, basically, one of the issues with the railways in the US is they have they're called Class One railroads, and they're the biggest railroads. And Canadian National are a bigger competitor, and they were bidding for Kansas City Southern to create a pan North American sort of railroad network. The problem was that actually Canadian National was perceived to be by the regulator, the Surface Transport Board, perceived to be too big. And so whilst there was Canadian National put in a higher bid, the likelihood of that bid succeeding was lower. And actually, when they actually went to get sort of clarification from the regulator, it was clear that that was not going to progress. Whereas the regulator had given a more favourable view of a combination with Canadian Pacific, which is the smallest, one of the smallest Class One railroads, the combination with Kansas City Southern, and having a more meaningful sort of lower sort of Class One competitor actually would be sort of more competitive to some of the larger players. So that's how it managed to achieve that. And we think actually the combination could be very interesting on a sort of medium to longer term view in terms of that having that that Mexico, US and Canadian network.
Brilliant, Mike. Thanks very much for your time, and we'll catch you next time. Have a good day.
Great. Thanks very much.